Would you like a handheld mic or would you like a
lapel or a
Six.
can you hear me? We're going to go ahead and get started. So if you all are staying for this breakout session, we would love for some of you to move up just a little bit more. I know there usually are not takers on that request, but if you're brave enough to come up a little closer, that would be great. And if you are not staying for the breakout session, if you don't mind networking in the hall, just so there's not a lot of background noise during the panel. All right. I think we're going to go ahead and get started.
Can you guys hear me? Yeah, is it working? Hopefully it's working. Oh, there we go. Hi, good morning. I'm Mike Walsh. I'm Assistant Director of Riverside County Housing and Workforce Solutions. This is here as our panel with a host of finance and experts across from both debt and equity. They were chosen mostly because they were sponsors of this panel, except for Dan. And so Dan, people from Rural List will find you in the back to make sure you get that sponsorship. And like some of you may be here to see Sebastian Glowacki with US Bank. He's claiming to be sick. So he said he has the flu and is not able to be here. He told us really late last night he was flying from Denver, so I don't really buy it. He didn't, but we love our friends at US Bank. Thanks for being title sponsors. But I think it's safe to assume like they think pricing is lower for US Bank, and you guys will beat them on all the upcoming deals. But along those lines, like you all probably have poured through all the CRA reforms, and I've analyzed that with CRA. We heard from Matt Joseph last night that really this means that deals in Elko, Nevada will see the same pricing as in downtown San Francisco. Is that what you guys have any sort of indication of how CRA reforms can be affecting pricing in the new year, particularly in rural America, or on both on the debt side as well as the equity side? Is that, or how are your banks and syndicators looking at it?
Well, I will start. Todd Fabian. I'm with the National Equity Fund. We are a tax credit syndicator. And I would say, Mike, I don't know yet. So the answer from our investor pool is they're not sure how this will impact their pricing. We don't think we're going to see a drop in the amount of equity that they're going to be putting into the market, but pricing is the million-dollar question. We believe that we will see a bump in rural pricing versus urban pricing, just from the nature of if you could do a deal, let's just say in California, it doesn't matter where it is, then you might go out there and be able to hit your CRA goals, not paying 95 cents for a San Francisco deal. So intuitively, that's kind of where I think the market will land, but we just don't know yet.
Bob and Jessica from both Chase and Wells, are you guys seeing any indications on the debt side on how pricing or CRA reform or even just larger pieces that would be affected?
Yeah, from Chase's perspective, I think it's very similar to what Todd had mentioned, that it's too early for us to tell. Just over the past few weeks since the reform.
Can you guys hear Bob?
Okay, we'll use this one. I think very similar to what Todd had mentioned, that it's really too early, that we're looking through what the changes in the reform mean for the bank and for the industry. Certainly, we think there'll be positive results. And from our perspective in markets where we are active and we have a footprint, we want to be in those markets. And so hopefully it's favorable pricing from the perspective of developers, but like I said, too early at this point, I think.
The other thing to keep in mind is, like all things governmental, this is going to take a long time to roll out. This is not going to be an immediate. As a matter of fact, the final rollout of all this doesn't happen until 2027, which could also mean that banks that are partway through their CRA cycles are going to be looking at this at that point. So this is we joked about it. We were talking about it earlier. It's a 500 and some page framework, which seems an odd term for 505 pages, but the true regulatory information has yet to come out yet. I think, I work for Raymond James. We're also a syndicator. And I've talked to 5 different investors. They've given me 5 different answers. So I think it's hard. I wouldn't go planning on getting San Francisco pricing in Elko today.
Mine on?
Can you guys hear Jessica?
Jessica, Wells Fargo. I'm on the construction debt side. Echo other folks. We still are waiting to get our analytics regulatory guidance on it. They've combined the lending and the investment portions, which is supposed to only have a positive impact on our CRA impact from our investment side. But we're still, waiting on final guidance. I will say that we're finishing up the last exam cycle. So like Dan said, it's going to be another 24 months before this impact actually rolls out. And changes are looking like it's going to benefit the rural areas. So.
Yeah. Now, I guess like along those lines and trying to get investment into rural places, are you seeing anything innovative that states or even some regulatory agents or even your banks are doing on trying to get investments maybe into tribal markets or into other sort of farmer communities or other sort of places? Are you seeing any sort of innovative spaces or maybe some even highlighting some of the challenges you see in investing in those spaces?
Yeah, so we Raymond James is a large syndicator, I think largest has been nationally for a long time. And we got into it doing Native American housing. So we got a big focus in that area. There are states that do set asides for Native American housing. They often, California just has a plan to have 10% of the rural allocation go to Native American. I think that's in the kind of the draft QAP. So we are seeing that in some states. New Mexico has that, or either that or there's point scoring a lot of times that benefit those projects. And they're obviously highly needed projects. And then you have other states where you have USDA set asides as well. So those are things that are, and those projects generally, from our standpoint, perform well. And so not necessarily concerns about that. I think that the thing that we're starting to see more that we can talk about more as a group is that, as things get more expensive in rural communities, both through construction costs and increased construction interest, there's projects that are having challenges with the construction, having the right general contractors in these areas. That's a challenge. And the thing we're starting to see is we're seeing more twinning, which is this combination of 9% and 4% trying to be done in rural markets to make the deals pencil. And that's challenging. I mean, it's hard to do a 4% deal in a rural market, as we all know. So, but we are seeing that more.
And the challenge is mostly related to like the level of rents that are able to, you can't support the same level of debt.
Correct.
And I guess like on that, go ahead, Bob. Yeah.
Without a mic. Well, just in terms of tag on what Dan had said, that in terms of trends or changes we're seeing, and I cover Washington State and Oregon, so a little bit different markets from California. There, the state of Washington has prioritized tribal projects with extra points in their QAP, as well as this year they have now prioritized farm worker housing, which what had really been a major focus for the state is around homeless housing, but knowing that that's not necessarily the biggest need in rural communities. So putting those on equal footing for points for 2023 and 2024. And then in terms of state funding, I think we may have seen this in California as well. So that has a big impact in rural communities that are also trying to provide, whether it's permanent supportive housing or other service enriched housing, really trying to match up additional sources. And in Washington State, it's this Apple Health and Homes initiative that has state funding that brings services to the project. And I think in California with the No Place Like Home does something very similar. So I think those are positive impacts in rural communities. So.
I want to dive in on this idea of costs, and I see like every project I know that we're working on with the county is coming in substantially over budget, but now we're not just seeing it on the construction side, but also now we're seeing it also in terms of the operations of these projects. Like, how is this changing cost market, changing how are you underwriting both the actual deal itself, but maybe also sponsors, and like how like that effect on the operations are really like affecting those organizations?
I mean, it kind of goes back to what you were saying. Some of the trends that we're seeing is a lot of money now is being focused towards homeless housing. So I do see a lot of, in the last 24 months, probably some developers in rural parts of the state that haven't done PSH deals that are now leaning towards doing them. So, and then it leads to the operating expense issues right now, which we're seeing across our entire national portfolio. And Mike, there is no good answers. We set up reserves. So a lot of this is putting pressure on us to set up bigger capitalized operating reserves when we close. And we're really focused on insurance. I mean, we all know that insurance is probably the biggest issue in most of our markets right now is getting course of construction, and then annual insurance is going up 200-300% a year, which we didn't underwrite. I don't think anybody here could have seen the insurance problems that we're having. So really, we're looking at dipping into operating reserves. I mean, that's really the only creative solution we have at this point.
Well, and I guess Jessica, you want to jump in here as well, like from a debt underwriter, like on the construction debt, how you guys are looking at it?
So, historically, we've always underwritten a lot of cushion into our construction reserve or interest reserve. But now we're considering the volatility in perm loans. And so when we're closing on our construction loans, we're making sure there's substantial cushion in our operating budget for maintenance, for increasing insurance, for utilities. And, it ends up being pretty understandably difficult for developers to meet conversion requirements given the higher costs. So the construction loan ends up being outstanding for a longer time, which adds even additional interest rate costs and builder's risk policy costs. So we're asking, and we're seeing a lot of equity investors come in earlier. Instead of coming in at conversion, we're kind of underwriting and expecting more money to come in at construction completion, even if there's not a lot of cost savings between the yield and the interest cost. At least there's some security and assurance that you're not going to end up with higher interest rate costs if you can't meet conversion requirements. Also, as we're looking at new deals, we're asking more questions. We're doing a lot more stress testing for these potential increases in costs. And we're highly monitoring water, the cost of water. We've had projects where we had to underwrite costs into our construction budget, but because before we got our building permit, we had some off-site water conservation efforts that had to be completed. And so this is an example of how access to water and the costs associated with that are also affecting our underwriting.
I guess affecting the underwriting, the stress tests and these sort of pieces that oftentimes they come from the bank's requirements and for whatever their insurance, or are you guys looking at any sort of relaxing some of those requirements or modifying them, or how you can make it work? Because stress testing necessarily means it's stressful, not for you, but it's for the developers.
Mike, we said that was a Sebastian question.
Oh yeah, we said
Yeah, I was going to say, we'll ask Sebastian that one. Yeah, it's cute you think that we can change that, but the reality, the reality is that we're like everybody said, I mean, this is all coming. I mean, thinking about this, it's real time. I mean, I think all of us have, I won't say all, but a good chunk of our deals going through conversions right now that are underwater, where our developers have put money in. We've maxed out the maximum amount of deferred fee. There's no more soft funds. We're doing this in real time, and our underwriting team is also seeing this, and we're trying to come up with solutions. And so, for us as a fiduciary to our investors, there's no way to say, hey, this is all going to go away and be fine in 6, insurance is going up, costs have gone up, interest has gone up, interest is maybe going to stabilize out, maybe costs come under control. But until that happens, we're going to, I think there's going to be very little relaxing on the underwriting side.
So under the LIHTC program, there are these things called AHIC rules, and they're AHIC standards, I guess is the best way to. So really what we need to do is focus on getting AHIC, which is, basically every investor in the country to get together and increase deductibles. Because I think that is one thing that could help alleviate this, would be increasing your deductible. And right now we have these AHIC standards that are probably 30 years old, and they need to be revised. That's for sure.
Todd, what does AHIC stand for?
I don't know, Mike. Affordable housing, initiative investor, crazy conditions.
Mike, just in terms of the expenses, part of it's not just the underwriting, but I think as Dan said, we're looking at projects that are already under construction, and we've spent probably so much of my time this year not looking at new projects, but the projects we closed last year that we didn't budget for, where interest rates are and some of the changes in costs, and now that some of those projects are coming to conversion and dealing with this new operating expense reality that we're in. So that's a big part of Hopefully we've seen the public sector step up. We've seen the sponsors step up as well, investors, when there's some extra basis, hopefully they're paying. Looking for solutions there. And then going forward, I mean, on the insurance, you touched on, that's probably been the single biggest increase line item. Last year, 2 years ago, we were looking at probably $150 to $200 per unit. I'm underwriting a project this week. It's over $1,000 a unit for their insurance. And so it's just hard to pencil those projects.
Is anyone looking at self-insuring or like how that could be pulling out, or how is that being treated?
Short answer.
You grabbed.
No. No, I wanted to, I did want to jump back to something Jessica said, then I'll try to avoid answering your question. Jessica did talk about the fact that and I think we're all looking at it, which is this balance of bringing our equity in sooner to help offset interest carry. And it is exactly that. It's a balance. Like, if Todd and I are going to put our money in 2 quarters earlier, it's going to go from, 90 cents to 87 cents, right? So there is just this, it's at some point, it's the math of what makes it work to put money in. We at some points have done things where we do, and I shouldn't say this in front of my lending friends, but we do equity only and take construction out of it. And, but that, again, that's kind of the balance of like, is that cost effective? Does that work? To answer the self-insurance question, we've seen groups try to do it. We're willing to look at it. I think, as Todd mentioned, we have gotten approval to increase our floors on the deductible on a deal specific basis. It's not across all deals, but we have been able to bump up. That's also very sponsor dependent. If you're a sponsor that doesn't have much liquidity, it's a harder thing to get approved because the projects can't carry the larger deductible. On the self-insurance, it's, again, I think it goes back to what the other thing Todd said is getting in front of the investor community and talking about, can we get away from AAA rated insurance, get to something else? Can we do some level of self-insurance? The challenge with self-insurance is almost all those pools are out there have are consolidating into specific areas. So I know in Washington and Seattle, there's a market of doing self-insurance. It's 25 permanent supportive housing projects in Seattle. Like that, the risk is too high for any investor to say, because if one project goes, that pool's challenged. So I think those are, I think they're good ideas that just, I don't see how they're going to be effective in the short term.
Good, Jessica.
So we have had to bridge insurance on some of the projects in our portfolio. Some of them, the ones that have hard debt and they're facing high insurance costs, they're triggering defaults in terms of debt repayment. So, and then in rural spaces, we're seeing with wildfire, with wildfire risks, some of the carriers aren't willing to renew the policy once it expires. And policies are increasing 400, 600%. So on many of our projects, we've had to bridge insurance by providing Wells Fargo insurance while the developer goes out and looks for an affordable insurance. And even as the most cost-effective insurance, it's still not a sustainable insurance option for the properties. So like Dan mentioned, we're also increasing our tolerance on deductibles with qualified sponsors, and we're looking at it from a situation-to-situation basis. Obviously, folks still need to have insurance, but we're allowing for higher deductibles, so variable cost is a little lower, and we're providing waivers. But as a bank, there's a limit on what kind of and how much we can waive. We don't have a choice on flood, but we are waiving terrorism insurance. It's a little easier in rural spaces. And then otherwise, we're having to underwrite to higher premiums.
No, I guess it hit on a couple of pieces. Like we talked about Bill, like on by sponsor specific or on these sort of pieces. In California, we recently saw a longstanding nonprofit in Los Angeles that they went under due to a wide variety of factors. But are you seeing how are you evaluating organizations and this idea of increasing costs as developers? If they're putting 100% of their developer fee into these projects to make them work, that's not money that they have for staffing and other sort of pieces. And what are those sort of stress tests being looked at?
Yeah, with the Skid Row Housing Trust going out of business this last year, we were NEF was a very large investor in that portfolio. So we've been at the forefront of untangling a lot of those projects. And most of the issues that came out of that portfolio were operating expense driven and rents that were not high enough. They weren't getting the highest rents possible on these units. So they had projects that were basically running the company out of business. So from our perspective, what we have learned is if you have deals right now that you're trying to get investors to look at, they're probably asking you more questions about your REO schedule than you ever asked, that they've ever asked. So if you have a project that has a below 1.0 DCR, you as development community have to be able to explain that to your investors if you want them to invest in your project. So that's one of the big things that we are changing, is just the review of these REO schedules and the financial capacity of the developers to basically cover the losses on those portfolio. But yeah, there's not a lot of good fixes out there, other than trying to get higher rents on your project and trying to bring your expenses in line. It's been a challenge.
Yeah.
Yeah.
Been a
But in line
challenge.
with that, I think we've always focused on, it's not just the real estate, but it's the strength of our sponsor. But I think even more so today, that's critical, that we're, as you look, Todd mentioned, we're looking at REO schedules, but yeah, I mean, in some cases with larger developers, we're working on one project. We know they have 6. So we really like to see those contingent liabilities. It's like, what else is out there? What really is the risk for this organization? And it may not just be on our project. And then taking a much deeper dive into kind of the day-to-day of an organization and succession planning. What's their staffing retention? Are they having lots of turnover, project managers? Can they really, even very experienced organizations we're seeing are having difficulty to execute because of some turnover. So those are all the things we're looking at on the front end these days.
And most of our issues are urban projects. So this is a rural community. So we haven't seen the same impact on our rural portfolio than we are in our urban portfolio.
Yeah, I mean, I think that's true. Although I've had several rural groups who, small, doing, kind of 1 or 2 USDA deals every 3 years. In some of these rural communities and these small organizations, you have an executive director, you have a CFO, and you have, they're just not large enough. And so by the time that, the executive director is ready to retire, it's really important that they have a succession plan, because we have projects where we're not sure what to do, and trying to go get a pool of talent to move to rural New Mexico isn't necessarily, Indeed is not working for that kind of job. They're not filling that job for us. So it's really, and the challenge is these are 15-year projects that we have. You can be 5-7 years in and have a realization that the person who, was really running the day-to-day is not able to keep doing it. So it's really something that people really need to look at about, as Bob said, succession planning.
Of course, Pedro.
Is this to Todd?
We already addressed the insurance question before you got here.
I give it about maybe a year or 2 before some developments are just not going to be able to afford it, and your sponsors are not going to be able to subsidize those projects. They may tell you, Pastor, I cannot support this development. They may want to give it back to you. All right. So what ideas do you have? And this is something I'm also talking to ACD about, right? It's just, we had a 400% increase in insurance. We went from 1.2 million to 3.8 million on a 41 unit portfolio, 500 million. So it's outrageous. Now, luckily, we have an asset management reserve. Some of the developments are USDA funded, so they have rental assistance, but there's going to be a lot of developments, especially tax credits, that are paying way too much. 1,000, that's about right. 1,000 per unit for insurance, and sometimes more. So we're going to need your assistance, investors, to help us out. I know some of the developments have operating reserves that haven't been touched. If you have approval rights, we may say, hey, let us use some of these operating reserves to subsidize the development for the first year. And then we may need your help advocating for more insurance companies to come back to the state. So definitely something's going to have to be done. Some of the developments will not be sustainable. And I think this is thank you. we need your help. And then maybe setting up when you do the deal, set up a higher operating reserve of insurance, right? Capitalized insurance. Now, that's an idea. Have a $500,000 capitalized insurance as part of the deal.
We have, going back to what we were talking about, we've done something where we've increased deductibles up and that allowed for 3 times what the floor was before, and then creating a capitalized reserve to help offset that. But right now, I think we're trying to, I agree, Pedro. Long term, it's unsustainable. I think a lot of us are having a challenge how to get past today. Even like we're bringing in upper tier reserves, not even project level reserves, to help some of these projects out to get to conversion. But I agree. I think
start thinking of $100,000 deductible. If you have any lower than that, it's just not going to work. It's going to double the cost of insurance. I know some of the investors have a $25,000 deductible. That's out of the question. There's no way that it's going to be affordable. So I'm telling you now, 100,000 is going to be the floor.
And I guess maybe I want to kick this up. Jessica, you spent a lot of time with Pedro recently, and like but I not just like that I'm sympathetic to that, but I'm also the idea of that you actually you brought in your chief credit officer to meet Pedro. That was very brave of you. But like, what are these? How did that go, and why was that important to you?
Sure. I just want to start off by saying we love Pedro, and
You love
and
the
our we love Pedro. And our credit officer is a tough cookie, but she loved Pedro. And so it was a great meeting. And I think when a credit officer has an opportunity to see the great work that folks are doing and the passion and their vision, it really speaks to their, they have their credit hat on, but at the end of the day, we're in affordable housing. And so I think our credit officer benefited from seeing, Pedro gave us a tour of all of the amazing projects that they've built over, decades. And the impact that they're making in single family housing and generational wealth. And so it was a lot more. It was a beautiful, beautiful meeting. Credit with Pedro. But aside from that, in terms of what we can do, I've seen on some projects, I'm not sure if this is kosher, but on some of our projects, the investor limited partner has left cash flow in the deal to cover some of the insurance costs. And these are projects that are at the tail end, but there are things that can be done. There are limits to what we can do as a bank. I'm on the construction debt side, so I have a different relationship with this, So anyways.
So you're saying like Tim McCann and Daniel Pearl on the Wells Fargo equity side, they're going to put some of their money in, like, just make this work.
I'm not speaking for Tim McCann, but it is, it is something that we've done, and it's on a case by case basis, and it depends on, a lot of factors. It's just an option, something that has happened.
Remember, we need your support. So be relaxed, be flexible in operating reserves. I like the idea of an capitalized insurance reserve on a new deals. That's a good.
So Pedro, yeah, when we're up front structuring these deals right now, we're capitalizing our 3-month operating reserve. And yes, we are thinking we would like to increase reserves. You'll never hear anybody on this panel fight on increasing reserves. It generally comes down to who's going to fund that reserve. And, it's either deferred developer fee, and most developers are like, now I'll deal with that problem as it gets here. But the bigger problem we're having is the deals that are they're in service. Those are, I don't know how we fix those. I don't know. We just have to release reserves. If you're getting resistance from your investors, then you just need to, scream louder.
Well, you've been going on existing reserves. Because we've had groups come in on existing reserves, and we're raising the deductible on those retroactively. Again, we've got to go to if to the extent we're putting it in a multi-fund, or that's a bigger, there's 30 investors in those funds. But we are trying. I think we're all actively in a spot where we're trying to make this work. At the end of the day, it's how are we to your point, how do we get investors to get back to being reasonable about this? Because a lot have left the market. We haven't even talked about builder's risk insurance yet, right? Like, so this is operational insurance. Builder's risk insurance has gone outrageous. If you can get it, I had a project that with delayed closing. It was the last thing. And we had a delayed closing for 3 months because I couldn't find builder's risk. So
And developers, you guys control this up front. You should ask an investor, what are your requirements? It should be one of your RFP issues or whatever you need to know, if, especially if you're working with someone you've never worked with. Make sure you get what you're going to be required for insurance. It's critical. You might as well negotiate it up front versus, at the closing table.
I would, on this issue of like the increased reserves, like for a long time, like you could capitalize reserves, particularly on maybe PSH projects. You would oftentimes have this big number hanging out. Come year 15 and trying to get the investor out, like the investor thinks that is their money. Well, maybe it is their money technically, but like it's like, but they try and like pull all this money out. So there's a big stress test at year 15. How are you guys treating that? How do you guys see this in terms of reserves? This is a layup question like for Todd and NEF, but like I'm just curious, like
So we've been very friendly with our development partners. And Pedro, you could step up and talk about our disposition process. We've been able to leave the reserves in the deal, but it really does. I mean, Mike, it's a good question. Every investor has a different take on it. So fortunately, if it goes into a CEF multi-fund or an NEF multi-fund, then yeah, the development community is going to get the reserves back. We have some investors that are not as, they want to ask questions. What are those reserves going to be used for? So again, upfront, you guys as a development community should ask for an early release of reserves. You should be asking for this stuff from your investors before you get to year 15, because we're willing to release reserves, in year 13, 14 for capital expenditures or whatnot. And then you could also ask those reserves to be, continued with the project. So we could put that in our LOI. So there are ways that developers can safeguard their reserves. But again, you're talking about deals that were negotiated 15 years ago. Maybe everybody thought that they would just stay with the project, and they're just negotiations with your investors right now.
right. Todd's right. I mean, it does depend on, we have some investors that are fine with it. We have some investors that might struggle with it. It should be an RFP point. The other thing that, the trick that I because I still, even at Raymond James, I'm still 95% nonprofit in terms of my clients, the ones that Todd doesn't take from me. But the trick that I use is I always tell my groups to like, tell whatever soft debt you have to put a condition in that the reserves have to stay with the project. And that, at a certain point, the investors can't argue with that anymore. So they'll kind of back off. So it's a bit of an end around about how to try to keep them in. But my point to all my groups is I want them to have the reserves.
Are you guys seeing any innovative things that developers or local jurisdictions or others that are doing to like address these rising construction costs or making deals in rural America work more favorably?
Can you repeat the
Jessica?
question?
Huh?
Can you repeat the question?
Are there any innovative things that are happening in like rural spaces with developers or local jurisdictions that are doing to make these deals happen or address like the rising construction costs or make some of these things, just anything? I will answer the question because like this for me. So in Riverside County, I would throw this out to like other jurisdictions out there that we've been using ARPA dollars. And there's a spend down date that you have to have these funds obligated by December of next year. But a lot of jurisdictions haven't found places to put those money in. Pretty much states, local jurisdictions across, and like you can put this money into affordable housing in LIHTC deals. It can be structured as a residual receipt loan. And so we as a county, we've put in close to $75 million of ARPA money into projects, bailing out many of Todd's projects.
Thank you, Mike.
To do that, to address these rising costs.
We appreciate it.
You're very much so. And so, but I think I would encourage like the group, this is something that like, if you haven't spoken to your local jurisdictions about ARPA, they may have had initial projects that were for wastewater, water, et cetera, but those projects may not be ready to convert. This is like a lot of money that has to be spent or it returns back to the treasury. So go knock on doors of folks, except Pedro, like we know where you're
I mean, so Mike, the only thing that we're able to really help out during construction is if you have a bond deal, you do want your investor to pay for those additional credits. So that is something that we have been doing on these projects, is we are out there raising new money for old deals, which nobody likes to do at any syndication shop, but that's the reality right now. So we are out there raising new money to help save old deals. So is it innovative? I think we have to do it. So
Yeah, and I guess when we think about innovative, probably we weren't saying anything. It's as it applies to rural areas, we're seeing less of that because there are less resources. Where we have seen more innovation in some of the urban areas, and in Washington State, where we've had the city of Seattle, we've had the state set up and put more money into urban areas. But what we're also seeing is that public money isn't necessarily immediately producing more affordable housing because we have a bottleneck. We don't have enough low-income housing tax credits with that being oversubscribed. So now we're seeing potentially fully funding projects as non-LIHTC to move forward. We have rapid housing programs where we're going out and buying existing apartment buildings, apartment projects throughout the city. So there are ways that the jurisdictions are trying to be innovative and respond within the constraints they have.
I mean, the standard fix is higher rents in our region, so we're going to get a higher perm loan. So you've got to go back to your limited partner and get approval to increase your perm loan. We buy the additional credits. Really, I mean, unless I don't know what else there is to.
I think you
close
do
that
bring
gap.
up an interesting point that I think actually causes me concern more than being innovative is the ARPA is great. It is limited. So there's a lot of states where ARPA has solved big problems for us. What happens next year? Because these things aren't going to be solved by next year. And there's not these pots of $75 million, thanks to you, Mike, that are there to solve these problems. And that's what causes it, that's the thing that keeps me up at night is what happens next year when there's not additional soft funding and these projects don't pencil anymore.
But the good thing is that we are now sizing our interest reserves based on, 7.5%, 8% interest rate. So, I think we should, no, but I don't think we'll see the problems going forward because these things are just, it's hard to close these things though.
So Bob and Jessica, are you saying interest rates are going down next year to 5.5%? Like, or where do you see interest rates next year?
We'll
Set it up.
look to Wells Fargo to see where the market's going.
So Jessica, like you had 5.5%.
We don't, if we had a crystal ball, I think we'd be millionaires, but I definitely don't know. We don't know. We have our economic consultants at Wells Fargo that have their projections, but
What are they saying?
they are saying that they're expecting interest rates to come down, but
How much is?
I don't think I'm at liberty to give a.
Well, we'll meet get to see Jessica in the hallway and see if she can give you that. As like Bob, like so now you've heard Wells's answer. Where is?
Yeah, I don't know if it's forecasts are secret, but that are generally the same forecasts that we're hopeful that later in 2024 we'll see some deflation in rates. Is that 50 to 100 basis points? That's anybody's guess. But I've also seen the yield curves, and they have up and down on this cone of where things could be. But generally, I think it's a positive outlook for next year.
And then if you're asking about specific pricing, I mean, our specific pricing is basically SOFR plus 200 basis points. That's where we're landing right now. So give or take.
Yeah.
Do we have any questions from the audience?
Yeah, Clayton Crowhurst from Oregon. Wondering two-part question. One, I guess on one side of the coin, as y'all are, I guess, getting more scared and doing more CYA work, what are y'all doing to not keep out smaller, communities of color, organizations that are coming out of those communities? I'm thinking about, super high liquidity requirements as you're underwriting your sponsors, talking about having these super robust, REO schedules. What's the balance there? And then on the, kind of other side of the coin, we're seeing, especially in Oregon, a lot of rural communities have, turned into kind of resort and destination, I'll call COVID resort communities where your most affordable market rate is 140 AMI. And so that's leaving, a 60% gap between 60 or 80 AMI where your grants are kicking in. What kind of innovative strategies have y'all seen developers do, or are y'all exploring to kind of hit that middle market tier where your grants are currently drying up?
Mm-hmm.
Do you want to talk about like Bend? Bend is a good
Yeah.
example. I mean,
The Bend was the thing that came to mind. So, but no, I was going to let you tell, you guys have a program.
oh
for-
yeah, well, so NEF, we do have a fund. So the investors are sensitive to the issue of trying to bring in new developers, minority developers into this industry. So we, in the last 2 years, have a special fund. We call it the Ahead Fund. It's a minority driven fund, and there are certain investors that have relaxed some of their underwriting criteria of developers so that developers don't have to joint venture with another partner and split the fee or barely make any fee. So the investors are sensitive to it. Our fund is $80 million. I think we're closing it this month. And we have another $80 million that will go out there and we will try to deploy. And it's really geared towards minority developers that do know how to develop. I mean, you still have to know how to develop real estate, but they don't have the deep pockets. So our fund is set up to maybe give grants so you can hire a consultant to help you get to the finish line. So I think the investor community sees the gap. And I think in the next few years, it's not going to be NEF. You're going to have a whole host of different funds out there that are targeting these particular groups.
When I do think that the ESG requirements coming in are impacting some of these large. So we have 3 different direct investors who are looking at their upcoming ESG requirements in terms of financial audit requirements, and looking at this kind of investment as an ability for them to make the kind of social change that they're supposed to be making. And so they're doing the same thing. We're relaxing some requirements. We're allowing for groups that are traditionally not, would traditionally have a challenge being underwritten in terms of their financial capacities. And I think that you said, I think you used the term robust REO schedule. I work with a lot of smaller nonprofits in rural areas. They're not robust. I think the thing that Todd was emphasizing is just, if you're going to be at a 1.0, you better explain why it's not running and where it should be. But again, we're familiar with the kind of projects that are in rural markets. We know that they can be a challenge. So they're not throwing off a lot, but we just need to make sure that we see how strong they are. And the second part of your question is Bend, or, to your point, in Oregon, it's kind of almost, there's a ton of places in Oregon right now that have become very, as everybody wanted to get out of Portland basically and move up to the mountain or move someplace else. The challenge, and unfortunately, I don't know that I have a great answer yet. Because as we know, AMI is lag, right? So it would be great if there was a real time, hey, this market just got bigger by this much AMI. And so now we can use those higher rents. But those HUD rents are going to lag 3 years before we can actually target them. So I think it's a challenge in a lot of, and not just in Oregon. Every state's got a market that has had something blow up in it. Montana's been crazy forever. It's hard to do things there. Idaho's had the same thing around Boise. So again, that's one of the challenges that I don't know if I have an answer for.
So we have, more than 200 million in CDFIs. Since we're banks and we're highly regulated, there's a lot of compliance. We personally can't finance, but I'm on a couple of credit committees for CDFI funds. And what gets approved, the LTVs that get approved and the underwriting standards that get approved are so fun. It's just so much space, and they're directed at exactly that, at communities that don't have access to the type of construction financing that we do for these light tech projects. But the way that we contribute to that space is through CDFIs.
And I would just say Chase working and supporting BIPOC developers has been a priority. And we see that, I think you're right, that there's this conundrum of we want to support this community, but they don't necessarily have a track record, experience, or a balance sheet. And there, in most cases, it is supporting where there's a joint venture between an experienced group and a newer developer, BIPOC developer. But we have seen other success stories. We have a group we're working with in Portland, a Native American group that actually partnered on 2 prior transactions that we weren't involved with. And on their third, they've been able to fly solo, but not necessarily with a robust balance sheet, but having that experience. And so for us, we really view that as a success story, that now they're kind of launched on their own, developing throughout the Portland area. So we hope to see more of that. But certainly, if there are ways, we're seeing the public sector try to support more of BIPOC developers. We're actually in Washington, Oregon, it's a priority. And also for bond cap in Washington, it's now required in terms of having a BIPOC organization or community-based organization as part of the development team. So certainly something we want to see more of.
I would say one thing to keep in mind in California under the regs for SIDLAC, they've created a special BIPOC set aside within that realm, but also I look at Shauna and either the maps are inaccurate and not great, but there is incentive to try and make other sort of investments in and get additional points for being in high resource or high areas. So a lot of our tourism areas like Palm Springs here, as well as La Quinta and others, they're getting additional bases as well as additional points in order to be competitive for receiving allocation of credits to somewhat of address this issue of like rents going up in some of these more resort areas. Do we have any other questions from the audience?
Just before we end, I mean, I wouldn't discourage anybody out there that hasn't done a deal to not do one. Just, I think investors are out there. They want to help you put your deal together. So if you are a new developer that is trying to figure out how to do it, just call Dan, call myself, and we can at least point you in the right direction. Because as long as you surround yourself with the right team, these deals are possible to get done.
Yeah, we've been doing this for a long time. We've both worked with brand new nonprofits who've never done deals before. So there is a way I just did 2 deals in Seattle with a regional Native American tribal coalition. They'd never done a LIHTC deal before. And we did 2 great projects that are supporting I think 56 tribes from indigenous Alaskans and Native Americans. And it's been great. And we've been able to, that we surrounded them with really good contractors, good property managers, have a consultant, and they're now going to go do their 3rd without, and they didn't give up like all their developer fee to do it. Like it's, so there are ways to get this thing structured, but there's not a whole blanket of, hey, here's what everybody can do. You do need to kind of come and say, hey, what suggestions do you have? And we're happy to do them.
I was waiting for someone to ask the question of Todd and Dan, but where do you guys see pricing next year?
Yeah,
That's yours.
Like Todd said yesterday, it's like a 15-cent swing.
Damn it,
so.
Mike.
yeah, there is literally a
We said we weren't getting this.
I was going to ask. I thought someone would ask it.
Sebastian,
Like
Sebastian would say.
price doesn't matter. Like it's all relationship is what Sebastian would say.
Is are you talking for Riverside County? You want to know for your deals?
I don't have deals. I'm curious for
For the deals you
people.
put money into?
I'm just a moderator here. I'm just trying speaking for the young.
He's keeping it.
Todd, what did you pay for Pedro's last deal?
I can't afford Pedro. Jessica's got Pedro.
Right now, till we see what happens with CRA, we're still seeing 95 cents in Las Vegas. And I've got deals that are going to get 82 cents in Las Cruces, New Mexico. So,
and I guess for maybe how does that in terms of sort of a yield or return? Is that like
yields are up. Again, talking about they did a much better job of ducking the interest rate question than I'm doing of this one. But because 10 years went up, all our economic investors kind of pushed up. So we were at, I would say, Todd, we were probably at a 6% return for economic investors 12 to 18 months ago. That number is at 7 to 7.5 now. It was 100 bips, and that's about 4 cents, and we're not people aren't knocking the doors down to be economic investors right now either. So, that's you're really targeting insurance companies, people who have liquidity. And then, I will say banks in general, the message we've been getting is, they want to hold fast. I think one of the things we haven't talked about here yet, and it's an impact whether you were in California or not, is losing Silicon Valley Bank and First Republic Bank was a hit to affordable housing in the West, period. That was $400 million of equity off the table overnight. And the downstream impact of that is there were a lot of regional banks that would go in with them. So there's, I think we've counted, there's another maybe $100 million and it's not going to go out on an annual basis on top of their money. And that impacts, for all those deals we're getting done in California, there was still some getting done in Nevada and other places. And that impact pushed out to the rural areas. where people then, because Silicon Valley was doing a deal in Oakland, maybe somebody wanted to do a deal in an adjacent county. That hurts. And I don't know how we're replacing that.
And I guess to go along those lines, like the bank consolidation and all of these sort of pieces, like US Bank, who pick up Sebastian, like merging with Union Bank, is that changing the amount of equity that's overall in the marketplace? Like Silicon Valley Bank and all these consolidations, like how is that like it changing how you guys are going out to the marketplace or even just the larger level appetite?
Yeah, I mean, in our experience, mergers do not mean increases in equity. So generally, when you have a Union Bank and a US Bank merging, US Bank is not going to pick up what Union Bank was doing. So that is generally the way that these mergers happen. So we have seen a shrinkage of multi-funds from these investors. So if they put in a certain amount, let's say where they were each doing 50 million, now they'll bring in 75 million into a multi-fund. So we are seeing that shrinkage because it just is what it is. And there's no way to really combat it.
And as good as JPMorgan and Wells Fargo are, there's still capacity, right? I mean, so they can't make up that level of loss can't get made up by the existing banks. And, we have regional bank mergers with Umpqua and Columbia State Bank, there's,
A Bank of the West just merged with BMO.
Yeah. And so again, that's another big one. BMO's platform is very good, but they weren't, Bank of the West had a very prolific relationship through California, but BMO's wants to get there too. So they're being very competitive, but like Todd said, it doesn't generally mean, hey, we're now going to, still keep the same equity.
So Mike, I got the mic again.
Who gave Pedro a mic?
So
Pedro gets his own mic.
It's like no one else has actually. Pedro gets his own. That is the host. So like,
Yeah,
work out?
I have a question. In terms of the underwriting, you made an interesting point. If the investor comes in earlier to pay off the construction loan, no offense, Jessica, but I'd rather pay off that loan because there's a lot of uncertainty sometimes, and it drags. And the sponsor has to deal with additional construction loan interest.
Right.
So who does that analysis? Would you do the analysis? Say, if I come in earlier to pay off your construction, this is what your rate will be.
Yeah.
So is that something you do, or something our consultant would do, or do we do to see what would be the benefit analysis of that?
Typically, yeah. Typically, you'd have if either you all use a staff person or a consultant. We'd look at the numbers and just say, okay, Pedro, or anyone, even not Pedro, here's what I pay under a traditional structure of, held out to stabilization. It's going to be this, and here's what my cost is to put money in every quarter to act as a construction loan. And then it just becomes, what's the math of how this works?
Right. Yeah. So Pedro, we just did this. We made an offer.
That's right.
We gave him a backloaded offer, which is, I think we paid 20% at closing and 80% at stabilized. But then we also gave them another offer, which was 20 and then 60 at completion. And then that little holdover for stabilization. And there was probably about a 3-cent swing between option A and option B. And they went for option B, which was the lower cents per credit, because we can demonstrate, hey, this is your holding cost during that lease-up period.
Right.
And it was, the equity that they were losing was less than the amount of interest they would have been paying. So it's a pretty easy decision.
Yeah.
And trust me, we all have that draw model. We can tell you exactly what we think the interest savings would be. And it's just up to the developer to make that decision.
Are you guys, can I ask a question?
Of course, Dan.
Thank you. Pedro, I don't want to interrupt you if you had another question.
Not that, but I don't remember any F lowering their pricing. They gave us the best deal possible, no change in pricing, whether they come in earlier or later. So that's what I remember. We want those deals again.
But it was so long ago that it's hard.
That's true.
How much are you guys doing on interest rate swaps and caps right now?
I would say most developers now are asking about those. And probably so the past month, probably every execution had one. I think some are like pulling back for a couple of reasons. One, not knowing where rates are going and thinking maybe long-term, we don't want to lock in on this. And second, there's some tax issues that have been raised that we don't want to go down that road by certain bond councils that make it maybe impractical to apply caps to tax-exempt bonds, that the developer might have to repay all of that savings later. So these are some things we're trying to figure out. And so I think that's a little bit of a chill on the projects closing over the next few weeks and into next year.
the projects that are closing in the next quarter, they've all asked about it. We're having discussions with our derivatives teams and making sure that, you know, the developers understand the drawbacks and complications of those those are complex products. Yeah.
There is an innovative program that I have seen in the last 12 months. And I know you guys won't care if I throw this out there, but there is a lender that is willing to do a non-prepayment penalty perm. So we have a developer that jumped all over that because they do believe interest rates are going to be reduced, and there was no prepayment penalty when you refinance in year 6, let's say. So that is innovative. I don't know how they're doing it because I know most perm lenders do not want to give you the ability to resize them or take them out, but that's out there. There are lenders out there that are thinking along those lines.
Yeah. Well, I think in fairness to the lenders, that some of those terms are driven by the equity side, that you want to have a perm loan in for 15 years through the compliance period. But I would say there's some flexibility on perms to do shorter if the investors were okay with that.
How much are you guys upsizing loans on existing deals now? Because I mean, you know, a year and a half ago, I would say we never upsized loans. We always underwrote to the max amount we could, but with all these problems that we've all been discussing, are you guys, I mean, we're getting it on a daily basis, right?
We have to, otherwise we don't stabilize. So yes, we have to increase the perm.
Michael,
And David,
thank you. I guess I want to ask for your opinion on something that's out there in proposed legislation, and then maybe ask for your partnership within your organizations to promote it if you think it's a good idea. The Affordable Housing Tax Credit Coalition and a bunch of folks in this room have ways to try to answer the issue you brought up about Las Cruces getting 84 cents on the dollar when other places are getting 90 plus. Sorry, I missed that part of the conversation, but we can get back to that a bit. Rural communities would be named in the Tax Credit Coalition's bill as difficult to develop by definition. And that provides a boost to the basis for identifying the value of the credit. We generally think that's a great idea. Certainly on the developer side, I would think on the bank side, since that boost is not actually your money, but it's putting more money into transactions which you can make profit off of, that you might be supportive of that as well. So the question is, are you aware of that? Do you see it as a potential positive? And then if any of the answers to that are yes, my request then is maybe that you can help us within the banks go to your government affairs shops and say, hey, this is something you could put a voice behind that would build our book of business and help these communities that the four of you clearly care about.
Well, certainly, I guess the first part of the question that we're not as attuned or seeing that at this point, but happy to make those connections with our government affairs and talking about how that could work or whether we could be supportive of that or not.
The one thing I guess I think it's a great tool to put. I think that, you know, I think we're all dismayed at the times where we have a project that's in a DDA and all of a sudden, as we've talked about last night, you know, we find out next year it's not going to be the DDA, so you've got to run through all these hoops to get in the DD to stay in the DDA. I don't understand how those determinations are made. We used to have discretion at a state level to add the 30 bips to whatever deal. I would love that to come back because I think it's needed. The challenge I'll say, and it not to close this out doom and gloom, but unless we get investors in the market, more investors in the marketplace, you still have to have a demand for that supply. So just because we're increasing credits doesn't mean that they're all going to get bought. And I think we've seen several things come through the market lately that, you know, I think there's also got to be a wholesale change on a policy level about corporations needing to be as involved as banks are in investing in these communities, because right now we don't have enough investors in the market to have everything clear like it should.
Jessica?
I had a little bit of a difficult time hearing the question. And then the response was a little different than what I heard. It was an equity question for,
David, like if I give for the question, there's and the Affordable Housing
oh, yeah.
the Tax Act, there's a provision that rural deals would get an additional 30% basis boost by just by the nature of being rural
Oh, yeah.
in DDAs. And if
Yes.
that were the case, then would Wells, Chase, everyone up here would sign on to be supportive to make push that effort through.
Yes.
Is that right, David?
Yes, that is something we would be supportive of. We do have ongoing conversations with the state on behalf of the bank to push for reform, and that is something we would be supportive of. So
You're preaching to the choir. We all would love to see every deal get the 30% basis boost.
Are there other questions? Like, do you have any closing thoughts? I thought this would be a livelier, we would go longer, but
Well, if Sebastian were here, we could have.
with Sebastian, like, we'd have an extra chair. Well, I thank everyone for coming, for joining us in this session. I'm sure all of us would be up here afterwards if any additional questions you have, but thank you so much. And let's thank our panelists.
thank you.
Yeah. But Nadia, do you need to do it? Oh.
Thank you again.